morning, everyone. Thank you for joining us for this quick update on China from Liang. As you can see in Liang's photo, he's sitting there in Shanghai. That's the view from our office. I'm not even sure at what floor he is. Maybe he can tell us, but it's quite high up there. We're gonna hold this interview style, so I'll post the questions and Liang will respond to them. If there's anything we don't cover, please feel free to pop us an email and we'll get back to you with your specific questions you might have. So I'll now hand over to Liang. Liang, one of the first questions is, with COVID going around the world and becoming the first global serious pandemic in the past century, what is the current situation in China?
Morning, David. We're sitting here on the 37th floor. So if you're wondering, that's a view from the 37th floor. And it's a really, really good question. I think to kick that off, so I did a very, very quick one and looked at the last 7-day average new cases of a few countries around the world. And what you can see is that, you've got Brazil and America sitting at over 20,000 new cases per day on average over the last 7 days. South Africa is closer to about 3,500 cases per day over the last 7 days. France, Germany, Italy are all the way down to 200-300. And here in China, we're sitting at around 40 cases new per day. I think China's been very, very lucky in the sense that although the virus started in China, we had a very, very strict lockdown. From day one, we had contact tracing apps. So there wasn't any of the privacy issues. There wasn't a lot of debate. There's very, very strong contact tracing through your cell phone. So essentially, you have a health code that knows that if you've ever been in contact to anyone close to having COVID, and instantly that health code will change. On top of very, very strict lockdowns, it means that we've been able to eliminate coronavirus in China almost entirely. And what that means is that the entire economy can restart. So by and large, everything's back to normal here in mainland China. Restaurants are full, schools are starting, transport's going on, domestic flights is happening, people are going on holidays, a lot of revenge buying, etc., etc., etc. Now, that doesn't mean that we are, complete. We've won the battle against COVID. I mean, certainly, even last weekend, Beijing had another new breakout from a seafood market. Over 100 people got infected, but within 2-3 days, almost 20 to 30,000 people were contact traced, given the infection that they've tested, and from there, all of those people are now in lockdown. Immediately. So they're in quarantine for the next 14 days, lockdown at home. So continue to be very vigilant, but luckily, more or less it's in control, and that the Chinese economy is more or less recovering from this point.
Sorry, I was on mute. What impact has COVID had on the Chinese economy?
I think the immediate impact is the first time you can see it is on the GDP growth rate. So the latest GDP number only come out quarterly, and China got hit mostly in the first quarter from the coronavirus. Now what you can see is a straight line down, right? So GDP, you look at minus 6.8% year-on-year growth. This is the first time China's gone negative in who knows how long. Probably the first time in around 40 to 50 years that China has had a negative growth on a year-on-year basis. So it's a very, very serious impact right at the beginning of the first quarter. Now, having said that, once you start looking at a little bit more of the economic numbers, especially the fast-moving ones, what you can see that they're coming through very, very strongly. So in terms of our economic model, what you can see is that, for example, China commercial car sales has grown 30% year-on-year. Right, you can see passenger cars are almost recovered at 0% year-on-year. Railway traffic, electricity, crude steel, everything has started to recover and moving away from zero, going positive. In terms of manufacturing PMI and non-manufacturing PMI, you can see both of them went, the most negative ever been in history, and they're both above 50 again. So certainly in the short term, especially in the month of April and May, the economy is showing a V-shaped recovery. Now, whether that can be maintained is very hard to say, given the global situation. But we can also say is that there's two other big takeaways from this, right? So the first one, going a step back, is that interest rate is at the lowest it's ever been since 2008. And I think that in itself is always helpful to the economy. It's always helpful to, to helping the market grow. So that's the first thing. And the second thing what I want to point out is that if you look at inflation as well, so if you look at our own economic model, you can see that the red line, which is inflation, across the board, we're showing deflationary tendencies. So there's oversupply, factories are not back at full capacity, there's unemployment, so there's massive amounts of deflation. And what that means is that the central bank has a lot of flexibility. It's in no rush to hike rates. There's no risk of inflation. And as such, you can have a situation where the economy is recovering, at the same time, rates are at all-time low. So for us, although weak, we certainly see signs of it recovering. And it's really, all else considered, considering the coronavirus, considering everything, we think it's a pretty good place to be. Now, taking a step further as well, if you look at what's happening around the world with stimulus packages and what's happening in China, you've seen that most countries globally have gone on this massive stimulus package. You're talking about 10, 15, 20% of GDP, which you have to borrow to do. But borrowing is not free. Borrowing is taking away your future growth. Vice versa, China has done a very reasonably small stimulus package because they can afford to, because just like us, they're seeing that the economic data looks like it's recovering okay. So they don't save their ammunition should it get dramatically worse. But if not, don't do this crazy large package. So what that means is that we're not going to have a lot of debt creation. So once everything is done, everything is through, and everyone's out of this coronavirus, I think when you look at it country by country, you're going to look at a situation where China starts standing up, where from a policy perspective, from a health of government perspective, from a market perspective, everything will be looking quite good actually by comparison.
We've been hearing quite a bit on Hong Kong, US or China-US relations. Maybe you can just touch on geopolitical risk. How serious is this Hong Kong protest, and how is that going to affect the US-China relationships in the long run?
I think it's a fantastic question. I think we have a US election happening this year in November. I think the Trump administration is polling very, very poorly. They're dealing with a lot of a weak economy. On top of that, you've had the coronavirus situation where US has become one of the worst affected places in the world. Right, the US has had one of the worst infection rates in the world, and what that has resulted in is a lot of rhetoric. That's because just like when South Africa have elections, the ANC will have a lot of rhetoric. I think what's happening certainly is that number one, the US will have a lot of rhetoric from now all the way to the elections. Simply because it's a popular thing to do. Bashing China is a popular thing to do. But what we're seeing, I think, is still a lot of rhetoric. I think if you take a step back, I think there's a lot to be gained from the two countries working together rather than working apart. So I think that's absolutely crucial. And I think furthermore, what's very clear is also Chinese reaction. So there's two main points there. So number one, the Chinese retaliation is always proportional, and they always try to retaliate less. So China always wants to de-escalate the situation. And their policy had always been to say, look, we're rejecting this idea that this global trade or cooperation is a zero-sum game. It's something where you and I lose and vice versa, right? And that's been proven over and over again in economic theory, is that global trade integration is beneficial to everyone. So that's the first thing. And the second thing is, like I said, they always try to de-escalate. So I think that's a very, very big part. And the second thing also is that ever since America started on their America First policy of essentially going at this very combative way around the world, what has resulted is an improvement in trade relations with China, with Europe, as well as China with Southeast Asia. And I think that's also a big thing for China, is that although, let's not get too scared, it's not a global trade war, not global protectionism. It's just the US fighting on this by itself. I think in terms of Hong Kong, it's a tough situation. But what I can say is that last year, for example, where you're seeing millions of people protest, I think if you look at this year, we're already down to hundreds of people protesting. So I think it may not be as big a deal as people think it is over this new security law thing. Right, so I think that may not be a bigger deal as people think it is. And finally, I think one of the crucial things I always see is that every quarter, investment banks release surveys about what people think the biggest risks are. And without a doubt, these surveys are counter indicators. So they tend to be showing what the market has priced in, but they are often very, very, very terrible at predicting the future. And today, sitting right here in the last quarter, one of the top risks that people identify is saying this geopolitical risk of this Cold War, of this breaking apart. But I think what's crucial to me there is that it tells me that, number one, the market has completely priced this in, or it's gone a very long way of pricing this in. And number two, I think there's a lot of room for improvement. The relationship is already very, very, very bad. It can hardly get worse, yet there's a lot of room for improvement. And when that happens, we'll see a completely different outlook and completely different outcome.
Since March, there's been quite a strong recovery globally. Maybe you can just touch on what valuations looks like in China. Has there been such a strong recovery there, or is the market as expensive as it is globally now?
Fantastic question. I think the crucial thing for us when we're looking at this, and that's also the amazing thing, we've been saying this for quite a while now, is that when we started this crash, China started from a very, very cheap valuation, right? So China started with a PE of 11. And even during the worst of the coronavirus, China was 10% down in terms of our stock market. Went from a PE of 11 down to PE of 10. And I think that's a function of the fact that there's not a lot of foam in the Chinese market. The Chinese market is very, very well priced. It's very, very cheap. Now, vice versa, if you look at the US market, what we've been seeing is a 30% correction. We've been seeing 5-6% moves daily, right? And what's been showing us is that there is a lot of foam in there. The US market is at an all-time high one-year forward PE ratio. We're looking at 27 PE ratio on a one-year forward basis, right? People are stuck between the fundamentals, which are very, very, very poor, with the Fed that's printing an insane amount of money. So you have this situation driving the US market very, very high. And the result of that is that, number one, there's a lot of volatility in the US, which you're not seeing in the Chinese market at the moment. And number two, what you're seeing is that the Chinese market is at an all-time low discount relative to the US market. So the discount reached today is the same discount we've seen before China went on a 100% rally 3 years ago. All right. And I think that to me is a very, very attractive opportunity. I think earlier on, we talked a little bit about policy and everything. And once you put it all together, kind of you're buying, a stronger market, a fundamentally sound market at a P of 11, at a period where they haven't done massive amounts of QE, the market's not bubbly, valuation very reasonable. I think it's a situation where you can see getting very high real returns going forward. In the Chinese market. So we really like the valuation in China. We think it's a fantastic opportunity to enter at the moment, actually.
How has the investment process been working in these extreme situations? And then importantly, maybe just touch on the performance of the fund. How's the fund been doing?
So in terms of the investment process, it's doing exactly as what we expected to do. So I think that's a really, really good news. Year to date, to the start of March, for example, equity fund is probably around up 1% alpha in terms of the investment process, in terms of us picking stocks. I think crucially to us is that as a quantitative manager, there's this opportunity called arbitrage opportunities that we look at in the market. And those don't come around often. Every couple of years, they start showing up and we take advantage of them. And I think what we've been seeing now is two opportunities that's the biggest we've ever seen in history. We literally have never seen this, even in the 7 years we've started this fund. So the first opportunity I'm going to talk about is AH shares. I've talked about them before. That's basically Chinese shares listed in Hong Kong, trading at half the valuation of Chinese shares on the mainland. And I think what's changed in the last 2 months is that the Central Bank of China came out with a paper highlighting this issue. And its recommendation was for the Chinese regulators, Chinese governments, to create to try a pilot program to close this gap. Now, to help you understand this opportunity, Anglos in South Africa, Anglos in London trade within 1% of each other, right? So the two shares almost never goes apart. People will just arbitrage this back and forth because you can buy Anglos in London, move to South Africa, and vice versa. So the two shares should never trade materially apart. Now, the same thing in China, CITICs in China versus CITICs in Hong Kong trade at a 50% discount. So the Hong Kong shares are trading at half price to CITICs in China. And if the regulators support this and close this gap, then we're looking at the Hong Kong shares catching up to the Chinese shares by 50%. And what it also means is we don't take any extra risk relative to the benchmark. So in the benchmark, there's about 5% of shares that's dual listed in China A and in Hong Kong. Now, what we do is just take that 5%. Instead of buying it in China, we buy it in Hong Kong. So we don't take any extra risk government's onto it, there's policies, they're looking at this. And when this changes in the next 6 to 12 months, the fund will make anywhere between 2.5% to 4% alone on this small piece. So that little piece of AH alone is 2.5% to 4% on the entire fund. So that's the first big opportunity in our process that that's come through now, that hasn't been around the last few years for quite a while, except for the last year when it started. It really hasn't been around. The second thing is even better. We've always talked about this, about future arbitrage, and that's just basically buying the market at a cheaper price. Every time at expiry, the future will get back to spot. So this one's even a better arbitrage with a known end date. And we basically locked in all the cheap shares to December this year. And what this means is that we're essentially buying the index at around an 8% annualized discount to the market. And 40% of our fund is doing this. So we dedicated 40% of our fund to do this now. And that's also going to come through. So that also is going to contribute anywhere between 2 to 3% over the next 6 months, right? And closer to 4 to 5% over the next 12 months. So you put these two arbitrage opportunities together, you're already looking at 6 to 8% in CNY. And on top of that, you've got the market movement and all the rest of it and the stock selection, everything. So really, really, when you put it all together, we think the opportunity is actually really good to enter at the moment and take advantage of these things over the next 6 months in an extraordinary period, in a period where this type of thing can happen because the market is under a lot of stress or panic.
And then maybe just to conclude, why should clients consider including China as part of their portfolio now instead of just making an emerging market allocation?
I think when we started the fund 7 years ago, I think we said what we tried to do with this fund is really give clients a source of real returns that's uncorrelated with everything else around the world. And in the 7 years that we've had this fund around, we've proven that very, very well. Since inception, we're doing 17% per annum. And year to date, we're doing about 16, 17% year to date in terms of this China fund. And I think it's exactly that you see, is that once you put it all together, the cheap valuations, the good policy making, the fact that China is a big country, the stable currency, this coronavirus is a perfect example, right? China was completely uncorrelated to everyone else. It moves its own way. It's less volatile. So when you put it all together, for us, that's a crucial thing, is that ever since we started the fund, that's been true, and even now it's been true, is that if you're going to buy one asset that's a very good diversifier that will make a material difference to your overall portfolio, China remains one of the best assets to include into your portfolio. And on top of that, you have opportunities to generate alpha, which is earlier we talked about the arbitrage, the stock picking, the asset allocation that we do in China. And so when you put it all together, I think that's what makes it attractive to me, is that you are going to get, over the very long term, there's attractive real returns that's uncorrelated with any of the other assets you have in your portfolio. And when you put that all together, I think that's what makes it attractive to me. I think it really does make a big impact, and it is one of the strongest funds since we launched.
Thanks a lot, Liang. I think that's all we have time for now. So thank you everyone for joining us. Have a good day. Cheers, Liang.